Hello, my name is Richard Triggs, and today on the Arete Podcast, I'm joined by Brian Cooke, who is the co-founder of MooCoo Ventures and an experienced angel investor with Brisbane Angels. Brian has had a fascinating career spanning sales and marketing, online gaming, technology, strategy consulting with PwC, mergers and acquisitions, and now early stage investing. In this conversation, we explore that journey, including what Brian learnt from building and listing a technology business only to have a regulatory change wipe out around 70% of its market value almost overnight. It's a fascinating conversation about technology, investment, risk, and where the next generation of great businesses may come from. So sit back and enjoy this conversation with Brian Cooke. Well, Brian, welcome to the Arete Podcast. It's been a little while, getting the opportunity to chat to you here, although we've known each other for a while, and most recently through Brisbane Angels, which I've been enjoying so much. So it's great to have you along to share your story.
Not a problem, Richard. It's good to be here and nice to be on the podcast.
Excellent. So why don't we just start off, Brian? Just tell us a little bit about what your current professional responsibilities are.
So currently I run a company called MooCoo Ventures along with Richard Moore. MooCoo is a venture syndication platform where we allow investors to invest in early stage startups. And MooCoo has a very strong relationship with Brisbane Angels, of which we also run as the administrator, even though Brisbane Angels is effectively a not-for-profit social group. So between those two, Brisbane Angels and MooCoo, we allow people to invest in early stage ventures. You've been along to a few of the Brisbane Angels meetings, very social, enjoyable.
I have.
Probably the thing you said to me was the misconception has been eliminated. There's a kind of a misconception that you need to be Elon Musk or Jeff Bezos to invest in early stage startups, which isn't the case.
Yeah, look, I'd like to come back and talk, in a lot more detail about that later in the conversation, because that certainly was, I've been hearing about Brisbane Angels for many, many years through my business. Obviously being an executive search, but as you say, there's this idea that, if I'm going to be an angel investor, I've got to have very deep pockets. But one of the things that I love, about Brisbane Angels, well, two things. It's such a great community. The people there I've only been to a few meetings so far, but they just seem so humble and friendly and accommodating and keen to share their knowledge, etc., which is great. And then the other thing is, to actually participate, the sort of hurdle rate in terms of investments is very low. I think it's about $5,000, isn't it, Brian?
Yes. We prefer the members of both groups not to be taking big bets. And that's because over the years, Brisbane Angels has been around since 2008. It was founded by John McTaggart. And so we have lots of data on, I suppose, how to do an angel investing properly. And I would say one of the biggest mistakes most people make is they become overly committed or overly emotive on something they really like. And they'll go, I'm going to put 100 grand into this. It's going to take off. It's going to kill the world. It's going to be huge. And some of them do. Some of them do really take off, massive growth, early growth, but many of them don't. So we prefer, I suppose, from an education perspective, that people investing either through MooCoo or through Brisbane Angels write a lot more checks, but smaller checks. And that gives you a portfolio, and that portfolio becomes somewhat diversified. And that's probably the single most important lesson that people need to take into account. And you have to treat it like a normal investment portfolio or your superannuation fund. In both instances, you don't put all of those assets into one particular investment, and we don't do the same thing in angel investing either.
Yeah, great. Well, let's, as I said, let's come back and talk about that in more detail. But one of the things, I was sitting down with you at dinner a couple of months ago, and you started telling us about your sort of life experience where you are now. It's so fascinating. And so, why don't we just spend a bit of time, talk us through, the evolution of Brian, like, where did you grow up, and when you were younger, what were you hoping to do, and how did it all unfold?
Yeah, well, I grew up obviously, well, maybe not so obviously, but if you listen to the accent, you'll figure out there's a slight Irish twang in there. I grew up in Ireland. I was probably a child of the 80s, growing up in that era. So I studied in Ireland and went to university in Ireland. I started studying law. But if there's any lawyers on the podcast, I don't mean to offend them, but I found it innately boring. And I switched after about a year of studying law. I switched and did economics. Now, that's an interesting story because technically I'm in Australia as an economist. So I came here as, I suppose, on a working holiday visa. That was I'm trying to think of the year. I think it was about around 1990 or 1991. And back then, immigration laws were a little bit different. So I came on a working holiday visa and applied for permanent residency, and you had to gain a number of points. It was a points system. So technically, the reason I'm still in Australia is because my economics degree got me enough points to stay at the time. And I've been here ever since. And look, the story is I came to Queensland in winter and kind of fell in love with it. It would be Queensland in winter would be considered a heat wave in Ireland.
Sure.
So, no, having said that, if I could leave Queensland in the middle of summer during the humidity, I would as well.
Yeah.
So it kind of sucked me in. Yeah, so I landed here. I worked for a while with what was then known as Queensland Cement. They sent me off on a bit of an international sitcom and for a while to Korea and Japan. Came back to Australia working for Telstra in Melbourne.
In an economist capacity, or
Oh God, no.
right?
Economics is as boring as law, I figured out after a while. So I kind of switched most of those roles into they were sales and marketing roles. So I would say most of my early career was in that sales and marketing type role. Eventually, I worked for ACP magazines in Sydney, and then what was probably best known in Queensland, Golden Casket Tattersalls, the lottery business.
Yep. With Robbie Cooke.
Well, Robbie was who I know well was at Queensland TAB at the time.
Okay.
And then we were in the lottery. So this was before those entities kind of merged. And while there, I started their first online gaming initiative, which didn't eventuate because at the time government regulations were very prohibitive, and the board decided not to go ahead with it. And that led me into, I suppose, online gaming. So a group of us here in Brisbane, primarily backed by Ken Talbot, who was with MacArthur Cole at the time, we set up an online gaming company. It wouldn't have been very well known because under the regulations, it was illegal to take bets from Australians, so we never did. So in a funny kind of a way, we had a very successful gaming business here in Brisbane that no one in Australia ever interacted with, and most of our audience were across Asia, Europe, and North America.
So, Brian, was that because you're an Australian company, so therefore you couldn't take bets from Australians, or Australians were prohibited from online gambling per se?
At the time, it was prohibited to offer gaming products to Australians. The kind of funny thing is, and we'll get on to where we are today from a technology. There's a great the story goes that how did we set this up with Ken? Ken was approached to look at the gaming license, the online gaming license in Fiji, and a mate of his introduced him to me to actually offer some advice, and I said it's worthless. Back then this was about 2001, 2002, maybe 2003, after the dot-com crash. I basically pointed out that terrestrial licenses in the age of digital commerce are meaningless and that he shouldn't do it. And I put in a throwaway line that, effectively, if you wanted to, by setting up a online casino, so long as you could get enough people there, you could have the possibility of being able to offer as many gaming machines as in the whole of Las Vegas. So digital commerce, everything gambling is really a digital product. It's permutations and probabilities. And so we set up a company here in Australia called Nuacon, and eventually that we did a backdoor listing into a company called Global Approach here in Australia.
Mm-hmm.
And that didn't go so well because about 3 months after we listed in Australia, the Americans brought down a ban on prohibiting payment systems for online gambling, and we lost about 70% of the market overnight.
Uh-huh.
These are the stories. You could say, did the startup listed on the stock exchange, which is an amazing achievement anyway. But that key lesson for me is never underestimate the impact of regulatory change and how government can affect a business, both positively and negatively.
For sure. And so when was that, Brian?
We listed the company in 2007 on the
Okay.
ASX, a backdoor listing.
Yeah. And then and when did this situation arise with the regulation?
3 months later,
Right. Okay. So almost 20 years ago.
almost 20 years ago.
Right. Wow. And so what's happened since then?
So what did I do then? I started working in what I call primarily technology and strategy areas as a consultant.
Mm-hmm.
And then I joined PwC in their consulting practice around strategy and operations. Stayed with them until about 10 years ago, 2016. I left PwC in 2016, which was a massive experience because I got to work on a broad range of clients that I previously wouldn't have had exposure to, big deals, mergers, acquisitions, etc. So it was a great experience. And since then, I have my own boutique investment and advisory firm called Cooke Capital. And that probably led me into the world of investing in other technology startups.
Mm-hmm.
The core thing is doing a startup or running any business is hard work. And so when you are the founder of a business, it's a binary outcome. It's going to be successful or it's not going to be successful. Whereas as an investor, you can spread that risk through diversification. So it's in essence, the returns might not be as high, but it's probably a smarter strategy than having one bet on one company or one startup.
Yeah, for sure. I know, I understand that completely. And so, Brian, obviously with your background and, having such a technology focus, and then, my experience at Brisbane Angels, a lot of the companies that are presenting for investment, seem to be quite AI centric now. I'm really interested in sort of exploring, and it's such a hot topic at the moment too, AI and AI in the investment space and so on. So, but before I sort of get into some particular questions, maybe sort of open the floor to, sort of your view on how AI is influencing the kind of things that you're involved with now.
Look, I think you'd have to be under a rock to not understand or the impact that AI is going to have. No, it's not all doom and gloom. I think it's both. There's going to be a lot of change. occurring over the next 3 to 5 years. And, we go back to where I kind of started the early days of the internet, digital commerce starting to emerge. I'm old enough to remember that if you wanted to, buy BHP stock, you had to ring up a broker. Or if you wanted to withdraw $1,000, you had to go to a bank. I think sometimes we forget, especially what happened in the past. Now, young people don't have the experience to go back 20 or 30 years ago, but if you look at the pace of change that's occurred in our lives, the digitization of our lives, everybody, it's been massive. We listen to music on Spotify. We do our banking online. We do our stockbroking online. We run our superannuation online. We buy our groceries online. There's been a lot of change over the last 20 years. Some of it good, some of it bad. I think generally we become more connected, but at the same time more disconnected on a relationship basis. But there's been massive change. And my reflection is that change that occurred about 20 years ago, we now refer to those companies as the big seven, Meta, Google, Nvidia, etc. They were all small companies. Like if we take the year 2000, 2001, we had the big dot-com crash, and everyone was thinking, oh, technology companies are not good prospects. But out of that dot-com crash came, what essentially are some of the biggest companies that exist on Earth today. Like I said, Nvidia was a computer chip company back then. Facebook didn't even exist in 2001. Google hadn't even done its IPO. So I think we're facing the same inflection point today that occurred 25 years ago. And is AI hot? Is it a bubble? I don't think it's a bubble. It might be hot at the moment, but I just know 10 years from now the biggest companies in the world will be AI companies. Full stop.
It is interesting, and I listen to a lot of podcasts, and there is, there was a view sort of 2 years ago, oh my God, AI is going to become the super race, and it's going to have artificial general intelligence, and human beings are, at the very least, are going to lose all their jobs, or they're going to become extinct, and so on. And then it seemed that a lot of that fear kind of went away, and then the conversation was more around, the CEOs of these AI companies are talking it up, in order to generate investment. But there are some constraints that mean that the likelihood of AI progressing much further is very limited. And then more recently, again, it seems that a lot of that sort of existential risk conversation is coming back. Would you agree with that?
In some regards, yes, and in some regards, no. I think the number one thing is that, even, Dario at Anthropic or Sam Altman at OpenAI, none of them can predict the future. No one knows where it's going. I think we don't fully understand the effects AI will have yet.
Mm.
But if you look at history, there were jobs that existed 20 years ago that don't exist today. But
Mm-hmm.
there are jobs that exist today didn't exist 20 years ago. So, your background, you probably, would have worked in an environment where we had telephonists. The larger companies had a PABX, and there'd be someone routing calls to various offices. Those type jobs don't exist anymore.
Mm.
But there's new jobs have been created, like, I think back 20 years ago, what was a product manager? I don't think those type of jobs existed. What was a UI designer 20 years ago? Those jobs didn't exist. So I think some jobs will be negatively affected, but a whole raft of new jobs will be created that we haven't even envisaged yet. And that's the change that's coming. And the companies that are positioned for that change, I think, will do a lot better than the companies that kind of sit on the sidelines.
Yeah.
I don't think you can sit on the sidelines.
Sure. I mean, you use the term, that we're facing an inflection point, similar to, what was happening around the dot-com crash. But obviously, there are some great differences between now and then. What would you say they are?
For me, I think this is vitally important. Most of us think of AI as Claude and OpenAI or Perplexity or the type of things that we're using today, and they're primarily digital. So let's call that digital AI. I was listening to another, I think, podcast with Jensen Huang from NVIDIA, where he claimed that physical AI would be 100 times bigger than digital AI. What do we mean by that? It's the physical things we use in our day-to-day lives will become more AI enabled. I was talking to a friend of mine who said, wouldn't it be great if we could have an AI chip in my coffee machine? I could just shout when I wake up, make me an espresso. No, we might laugh, but that's probably not that far off.
Well, I've pretty much got that already. I've got a Breville coffee machine. It's got a little app on my phone, and when I wake up in the morning, I just turn it on, and it starts remotely. And then when it's ready to pour the coffee, it sends me a little, okay, we're ready to go. So it doesn't quite make the coffee completely yet without human intervention, but it's fantastic.
Like I was watching, I think it was an Instagram reel from one of my friends who was in San Francisco recently and hopped into a Waymo, which is a driverless taxi.
Yeah.
And when he came back, I was discussing, were you apprehensive? And he said, yes, of course I was, because it's so strange, but I was strangely excited at the same time.
Yeah.
And so, while that technology isn't working perfectly and it's kind of stage gated in the San Francisco area, we've got Tesla and BYD and a whole range of companies working on this concept of a driverless car. And the technology needed to make that effective is actually far more complex than the AI we're looking at today, because it's not a language model, it's a physical model, it's sensing, it's data. And also what we call the latency needs to be so much higher. So if you have a car, like if you've used, let's say, ChatGPT for something and you get the revolving sign working on it, you can't have that in a driverless car.
No.
It's approaching a pedestrian. So, but I believe all those things will be solved. So this is a long way of saying, can't actually remember the question, but what do I think? I think physical AI will be bigger than digital AI. And in Brisbane Angels and MooCoo, we're looking at those opportunities, even here in Australia. Yeah.
Okay, so let's move the conversation now to talking about investing. And before we talk specifically about Brisbane Angels as a vehicle for that, just in general in terms of, the investor market now, where do you see the opportunities, and also, what are the mistakes that you think that a lot of investors are currently making?
So, look, all investing is a balancing act between return and risk. And so, if you're ultra conservative and you don't like volatility and you just want certainty, you could put all your money into government bonds and you'd probably get a 4% return. They might go up a little bit. Commercial property, maybe you're getting 10, 11% per annum, a bit more risk, especially with government regulation and tax changes. You go into the public markets, what have you got over the last 10 years? Maybe 12% return. And if you had a mix between Australian shares and international shares. And then you go up into the higher risk areas like private assets, private capital, private equity, and of course, venture capital. No, there's no what I call global data for angel investing, but we take uh, venture capital as a kind of a proxy because we're basically doing the same thing, early stage venture investment. And the averages that you can see over a long period of time are 18 to 20%. So you get higher returns, but you have to manage it carefully because you do need that diversification. What we see is uh, what they call the power law. So effectively, unlike other forms of investing, there's high failure rates in what we do, and therefore we need very high returns in the ones that succeed to compensate for the losses in the ones that fail. So it's very hard to do that uh, unless you're either a professional venture group or you have the benefit of a group and a collective approach like Brisbane Angels or MooCoo. And so we have the power of the crowd. You would have experienced, Richard, that we might be discussing a thing like, I'll make it up, civil engineering, and we have a civil engineer in the room who can bring perspective. We might be discussing a medtech startup, and we've got medical people in the room who can bring perspective, and that's the real value. So, uh, from an investing perspective, if you do this right, it can generate very high returns. If you do it wrong, you can lose a lot of money.
And so how would Brisbane Angels track record demonstrate that?
We publish some returns. So Brisbane Angels is not really a fund, but if you can imagine, if you took the holistic view of all the investments made by Brisbane Angels and assume it had been a pooled return, then Brisbane Angels actually outperforms the venture capital index here in Australia, or at least it did last year when we last did the return. So we've been generating about a 22% internal rate of return for the last 15 years, which is 22% compounded every year for 15 years. Now, I should add a caveat to that. That's an average, and some of our members have done way better, and some of our members have done worse.
But then, of course, every month, 3 investee opportunities they present. There will be some people in Brisbane Angels who want to invest. Others may want to invest in other things. There are some people who are purely spectators who are just, there for the experience and the community. So, I mean, how do you sort of calculate that to say, across the board, there's a sort of a 22% return?
So the 22% return is only on the ones we actually invest in. So if we're not investing, as you would have seen, what we try and organize is give 3 founders the opportunity to pitch every month. And in that room, it's mainly a room of investors or people who have an interest in this type of thing. So the return that I stated is kind of the pooled return across all the investments made by all the members averaged. Now, probably the important thing to remember is different people have different strategies or likes or dislikes, etc. But what we have shared and analyzed is that as your portfolio grows, your return on investment grows. And so we think that to have those type of returns that I've just mentioned, you need at least a minimum of 20 investments. And a good way of thinking of this is if you came to me and said, Brian, what should I do? I'm thinking of putting 100,000 into company XYZ. I would say, Richard, wrong strategy. You need more diversification. And my recommendation to you would be start writing $5,000 checks over the next 2 or 3 years into 20 companies, or a derivative of that, depending on how much risk and diversification you wanted. But putting that 100,000 into one company would be, the probability of that succeeding is only about 4 or 5%.
Yeah, and so most people would do that, if it's their kid or their friend, so they're that sort of early stage family investor, and the person needs some money to get the business cranked, right?
Yeah. and it would still be wrong.
Yeah. And one
From
of the things,
from a purely investment perspective.
sure.
Look, there's different things that motivate people, helping relatives or friends get a business off the ground,
Yeah.
but the statistics show
Yeah.
that the probability of putting one investment into one company has a low probability of return.
Yeah.
And therefore, a far better strategy from a financial perspective would be to spread that out across a more diversified investment portfolio. Uh, but emotions get in the way, biases, personal biases get in the way. And so people despite knowing this, they make a motive and sometimes illogical choice.
Sure.
That's big. But we're human. That's
Yeah, yeah, and I suppose also, Brian, it's not like you put your money into an account, and at the end of the year it says, "Oh, you've got 22%," right? Some of these investments may take many, many years to yield. Yeah. Okay. Right. Sure. And one of the things that I'm encouraged by is that at the end of the day, I think that I'm a pretty good recruiter, but I haven't got a clue about investing. But the great thing I see within Brisbane Angels is that you can actually piggyback. So there are some very, very smart and shrewd investors in the room, including yourself and Richard and Carl, etc. And so I kind of look at it as, well, if they're prepared to back this, then that's a good indication that I should too.